Thank you for joining us tonight. This webinar is proudly brought to you by Bursa Academy, where you can unlock a world of financial learning. Bursa Academy is a comprehensive platform that aims to provide investors with a continuous and holistic learning journey. You may access Bursa Academy by scanning the barcode on your screen, or you may visit it on www.bursaacademy.bursamarketplace.com. Our topic for the evening is BMD FM70 Index Futures Series 1 of 3. Index Futures, getting started on the right foot, will be our starting one today. Ladies and gentlemen, just before we continue, questions will be open to you through the chat feature in the Zoom platform, and your questions will be addressed by David Lowe after his presentation during the Q&A session. Please tag your questions by mentioning your name, where you're from, and the question. Just as a repeat, you may type your questions in the chat feature. Please make sure you tag your questions by mentioning your name, where you're from, and your question. So, ladies and gentlemen, our speaker for the evening is David Lowe. David is a trader and managing partner of Exmodius Trading Group PLT. David has 24 years of experience in Malaysia's listed derivatives industry. Before starting his own consultancy, David held leadership positions in futures brokering divisions of major investment banks in Malaysia. David also served as the president of the Malaysian Future Brokers Association between 2018 and 2019. David has also spoken in seminars and workshops to over 5,000 retail traders on trading Bursa Malaysia derivatives, as well as the CME, Singapore Exchange Limited, and Hong Kong Stock Exchange markets. His work includes live market trading sessions and webinars. So without any further ado, David, I hand the screen and the floor over to you.
This is probably the last 10 days of the year 2020. And we've almost come to an end. This has been a fantastic, very, very volatile year. And we end this year with some new products that just have been relaunched by Bursa Malaysia Derivatives. And this is the topic that we will be talking about today, FM70. We will also be talking about index futures, other contracts that are available on Bursa Malaysia Derivatives, basically talking about how you trade index futures. This is the first of the three modules that we will be covering. The first we will talk about, which is today, is about the product and about the unique features of index futures. For those who are new into index futures, perhaps an introduction to the product and how you start trading, how you get started. This is very important. And then in the next two sections happening in January and February, we'll cover the more exact details on what are the strategies you can use, how to trade properly, what's the proper capital, and lastly on February, we talk about the game plan of trading index futures. So tonight, this is what we will cover. The first is why trade FM70 index futures? Why is it so unique? And why is it that you should add it into your trading arsenal? Okay. The second is what is that you need to know about the basics about trading index futures, and this is very important as well. The fourth is how to enhance your investment returns using index futures, and lastly, what are the do's and don'ts? Where are the pitfalls? Where are the opportunities that you need to look out for when you're trading index futures? Right. So let's jump into the material. Okay. Okay, so for those who are new into what futures are, just a quick introduction about this futures universe. Basically, futures contracts are tradable instruments which are listed on exchanges. So tonight, of course, we're talking about products listed on Bursa Malaysia Derivatives. And these products are based on the price movement of underlying assets. Okay, what are underlying assets? Underlying assets could be things like stocks and shares. It could be stock index, which is the topic that we will be talking tonight. It can be like precious metals as well. It can be gold futures. It can be silver futures. It can be commodities as well, like wheat futures, corn futures, or in Malaysia, the crude palm oil futures, right? Or it can be in financial products like interest rates and bonds. So all these are what we call the underlying assets. And futures contracts basically are contracts that are based on the movement of these underlying assets. But one thing is this, you don't have to own the underlying asset to be able to trade the asset itself. So that's one unique feature of futures contracts. They track the prices, but you don't actually own the underlying, what do you call that, assets, okay? Of course, sometimes for those involved in commercial trade, they can actually own the underlying what do you call that, assets at the end, at the expiry when they take delivery of the product, especially in commodities. But this is normally for those who are in the trade, those who are in the who are dealing perhaps in crude palm oil or wheat or corn. So those are a special category of players that actually take the physical delivery of the underlying asset. So most of the traders do not take what do you call that, the delivery of these physical commodities. Right. So in a nutshell, that's what futures contracts are. Tonight, we will be talking about stock and equity index futures. So what are these index futures contracts? Basically, the futures on equity index futures are one of the most popular futures contracts traded around the globe. And for those of you who follow, say, Bloomberg or CNBC, watching the news on the internet, basically, or even on television, you will see a lot of times throughout the day, people talk about the Dow Jones futures, how's it opening, how's it trading off market. They talk about S&P futures. These are all what we call stock and equity index futures contracts, right? So basically, in terms of equity index futures contracts, these are reference to the movement of the underlying indexes, right? So in index futures, the most famous ones, of course, are the U.S. Indices like S&P 500, the Dow Jones, the Nasdaq. In Japan, of course, you've heard of the Nikkei 225 index, and in Hong Kong, of course, the Hang Seng index. In Malaysia, what is famous, of course, is our KLCI index, of which there is a futures contract called the FKLI, the FTSE Bursa Malaysia KLCI futures contract, which is based on the FBM KLCI. And of course, relaunched last week on 14th, we have the freshly relaunched contract, the FM70, which is based on the mid 70 stocks of Bursa Malaysia. All right. So a stock or equity index futures is defined as a contract to buy or sell a specific index at a specific price on a specific date. Right. So that's the definition of a stock index futures contract. We will get to talk and elaborate more on this as we go along. Okay. So in terms of popularity of stock or equity derivatives volume, this year in 2020, with all the volatility happening in the market, in the Dow, global markets, Malaysian markets, Asian markets, in the first half of this year, 2020, according to the statistics from the Futures Industry Association, FIA numbers, the trading volume on equity index futures have totally exploded, and volumes have soared 51% compared to the previous half year in 2019. And of all the contracts, futures contracts and options contracts traded throughout the world, the equity products, which is the stock index and the stock futures and options contracts, accounted for almost 60% of the total volume in the first half of 2020. And I think if you look back in the last 6 months as well, volumes have been gaining as well. So it's very, very active. Okay, one is because of the movement in the markets, the stock markets over this year has been very, very volatile. Those of you who have been following the markets, of course, since February February, March, you've seen the market totally tumble down and then took this quick and V-shaped recovery up to new highs. So it's been a very volatile and actually a very exciting journey for those of you who have been trading futures. And it will be looking forward into 2021. We're looking at a very, very exciting year coming out as well. Volatility is here to stay, and the volatility is very, very good for those who like to trade the index futures. Okay, so for those of you who invest in the stock market, what is the difference? What's the difference between trading a stock index futures and trading the stock itself? So we have a comparison table over here, which contrasts between these two products. So in terms of stock, those who are familiar, of course, you are basically trading the underlying share listed on the stock exchange. You actually directly own the shares that you buy in the stock market. So you are the registered owner, and in Malaysia, when you own these shares, it's registered in the CDS register. You are the owner of these shares. But in terms of index futures, you are trading the underlying basket of stocks which constitute the index. For example, if we are talking about the KLCI index futures, you are basically trading the top 30 stocks of the KLCI, which are the constituent stocks in the Malaysian FBM KLCI. You don't have any direct ownership of the underlying shares because you are trading the index, and the futures contract that you trade is settled and cleared by Bursa Malaysia Derivatives Clearing. So there's a difference between the CDS and the Bursa Malaysia Derivatives Clearing, right? And in terms of this number 4, the fourth comparison point is a very, very important difference is when you are trading stocks, there is no leverage, okay? Unless, of course, you're taking share margin financing. You're taking financing to buy your shares. There's no leverage, okay? That means you pay basically for the full sum of the shares or value that you have bought. But in futures, it's traded on margins. And this is a very, very important distinction. And we will cover this at length in the next couple of slides, because this is a very, very interesting feature of trading futures. And most of the people or most of the traders that come into under the futures market to trade futures are looking forward to this particular feature in the index futures. All right. So in terms of cost, trading costs in stocks, you have the brokerage comm, you have the clearing fee, stamp duty, of course. Very similar in index futures as well. You have your trading costs, brokerage commission, exchange fees, which are very similar. But in terms of how it is charged, in stocks, there is, of course, a percentage of the value of the shares that you have bought. In futures, it's a per contract basis. So sometimes in terms of the cost of trading index futures, it can be actually cheaper compared to trading the underlying stocks itself, right? And another distinction between stocks and futures is this, which is point number 6. There's no expiration on the holding period as a shareholder of stocks. But in index futures, we have what we call an expiration cycle. Okay, that means in every single futures contract, there's a certain months that you trade. And after that particular month had expired, you either have to trade the next month, roll your position forward, or you choose another month to trade. So there is an expiry, right? So as I said here, holding a long-term position may require you to roll forward your positions. Okay, so this is something that you have to keep in mind as compared to stocks. So this is comparison between trading stocks and trading index futures. So we go down to this. Why do people trade stock index futures? What's so interesting? Okay. Why is it so versatile? Okay. Number one is, as we said just now, traders come in and choose index futures mainly because they can greatly enhance their returns through leverage. Okay. And leverage is a very, very powerful tool. Okay, and we will see how your true leverage, you can actually multiply your returns from 4-fold, 10-fold, even 20-fold, right? The second feature is traders get immediate exposure to the price movements of stock constituting the index. if you're trading the FKLI, which is the top 30, it's reference to the top 30 shares of the KLCI, you're basically trading the blue chip stocks, the top, what do you call that, capitalized shares in Bursa Malaysia. Now, a lot of people feel that trading blue chip stocks is expensive, right? Because those shares are quite expensive in terms of the price. So a lot of people will trade probably second liners of the smaller shares because of that, okay? But using the index futures, you can actually trade the price movements of these top 30 stocks, okay? So traders like it because they're able to trade the blue chip stocks in a very, in a way that's affordable, right? When we'll talk about that later as we go into the slides. The third thing is the flexibility to trade a bullish market or a bearish market. So in terms of looking back in 2020, early 2020 in the first quarter, right? If you are just a stock investor, or you just trade the equity market, it'll be quite challenging, okay? Because the stock market is coming down. So they don't have, in that sense, in a falling market, the opportunities for profits is very limited. Of course, if you were in rubber stocks this year, as the markets were falling, you would be looking pretty good, right? But generally, as the markets come down, you don't have opportunity because the share market or the stock market is, how shall we say, is a one-directional market, in the sense that you make money only when the markets go up. But in futures, you have the flexibility to go long if the markets are bullish, or to what we call go short in a bearish market sentiment. So it's a lot more flexible. So in terms of markets, equity markets which are not doing well, you can still have profit opportunities. So that's another thing that traders actually look out for when trading the stock index futures. Now, the fourth feature is also very interesting. You're not required to do any stock picking, right, compared to trading individual stocks. So in trading index, basically you're trading the broad market, so you don't have to stock pick. Of course, and when you're trading shares, you must stock pick. So basically, you are involved in. You need to be a bit more precise when choosing your shares, right? But when you're trading stock index, is the broad market. You're trading the general sentiment or the broad market sentiment that is currently in the equity market. So that has certain advantages, okay? Because some people may not be good at stock picking. In fact, if you read articles or books by Warren Buffett, he said the individual retail investor may be better served by trading an index itself or an ETF on the broad market itself. Okay, so that makes trading and investing a bit easier because you don't have to pick your stocks. Okay, that's one advantage of stock index futures as well. Right, ability to go short, we have spoken about that. Ability to trade bullish and bearish markets. The hedging. Okay, hedging is one thing that a lot of these institutional traders and corporates come into the futures markets basically to protect their portfolio. This may be a feature that we will talk in the sessions on the second or third sessions, just to give you a flavor of what hedging is about. Basically, it's about protecting. If you hold a portfolio of shares, you can use stock index futures as an insurance if the broad sentiment is bad, just like in the beginning of this year. You could use stock index futures to actually hedge and protect your portfolio from a fall in the prices of the shares. All right, so that's called hedging. And the last one, we spoke about that, potential lower trading costs due to the way it is charged per contract rather than the full value or a percentage of the value of the shares, right? So these are the main features why stock index futures are so popular amongst the traders. So we move on and talk about the FTSE Bursa Malaysia Mid 70. This is the product highlight tonight. When we talk about the FM70, which is a futures contract, it's actually based on this index, the Bursa Malaysia Mid 70 index. And those of you who remember the KLCI, previously the KLCI actually comprised of 100 top blue chip shares in the Malaysian KLSE, right? And then later, when this, what do you call that, the index was partitioned to the top 30, which became the KLCI, and then the next 70 became the FBM Mid 70. Right, so this was the second part, or the next 70 companies ranked by full market cap after the FBM KLCI. Okay, so these are still also blue chip counters, but this is the second 70 out that 100 that used to be the KLCI. And this is a tradable index, means that it can be made into a futures contract. It's calculated every 15 seconds during the market hours. So in this diagram, you could see the partitioning of the KLCI, the mid 70s, and which was part of the FTSE Bursa Malaysia Top 100 Index. Okay, so this futures contract, the FM70, is based on this index. And those of you who are familiar with the shares in the mid 70, this is the list of the constituent shares. Okay, do note that today in the 21st December, there were some changes in the index. In the KLCI had some changes. There was a replacement on the KLCI. There was one stock with Supermax, which was put into the KLCI. And then in the mid 70s, I think, not mistaken, there are 8 shares, 8 stocks that have been substituted. So some of the 8 shares that you is not no longer in this list that you see over here. There are some new names already put on. So you could check out using this link below to see what are the new stocks that has been put into the KLCI mid 70. Okay, basically you can see that they're very interesting stocks as well. So the mid 70 is actually very interesting in terms of the movement. There's a lot more volatility as well. So for traders, this is very, very good. We go down. Okay, so this is the FM70 index futures, and it's been relaunched. It was previously launched in 2018. Right, and basically the index futures provides you the exposure. We spoke about the mid 70 index, the 70 constituent stocks, revamped and relaunched last week, Monday, 14 December. There are 2 main things that you need to note here. Previously, the contract was a smaller contract in that sense that the contract size was a multiple of 2 ringgit. Now it's multiples of 4 ringgit. What does that mean? The contract size is basically the FBM mid 70 index, which is now about 14,000 to 15,000, multiplied by 4 ringgit. So if, let's say, for example, the FBM mid 70 is 15,000, you multiply by 4 ringgit, then the contract size is worth, or the notional value is worth 60,000 ringgit. Okay, so that's one of the main changes. Now, the minimum tick size also has changed. Okay, currently now with the new relaunch contract, the minimum tick size is 5 points. Okay, so every single point on the FM70, you remember this multiplier of 4 ringgit is 4 ringgit. So 5 points times 4 ringgit, that means that the minimum movement is actually 20 ringgit value. Okay, we'll get some examples so that you understand how this works. Now we'll move on to the contract specs. The contract specifications is basically how the exchange, the terms for trading this particular contract, all the terms and conditions are there. So this is a part of the contract specifications. You can see the contract code is FM70. The underlying instrument, of course, is the mid 70 index that we have mid 70. Contract size, again, the index times 4. Okay, index times 4. So every single 1 point movement on the mid 70 index is worth 4 ringgit. If you are trading the FM70, every single point is worth 4 ringgit. Okay, but of course, every tick size, it doesn't move by a single point. It moves by 5 index points for the futures. So every 5 index points times 4 will equivalent to 20 ringgit. Right, now take a look at the trading hours. Okay, the trading hours, we open at 8:45, so it's 15 minutes earlier than the stock market, and we end at 12:45 in the first session, which is 15 minutes later than the stock market, the Bursa stock market. The second trading session opens at the same time as the stock market, but ends at 5:15, 15 minutes later. So in terms of trading the futures, you will see the futures trade earlier than the actual FM mid 70 index opening, and then later in the closing session, 15 minutes later. Okay, so that's one of the difference in terms of the trading timing. Okay, so these are the other things like trading price limits, what are the limits that the prices of FM70 can go, the final trading day. Okay, now this final settlement is important. This is cash settlement. Okay, that means at the end of the expiry, let's say, for example, if you're trading the December contract of the FM70, at the end of December when it expires, what it does is it will cash settle. That means whatever profits and losses at the end of that day will cash settle and the contract will expire. Okay, some contracts on futures are actually physical delivered. Okay, so like the crude palm oil contract, if you hold it to expiry, you are liable to take physical delivery, right? So that's the contrast between cash settlement and physical settlement. So in terms of indexes, globally, usually most, if not all, of the index futures are cash settled. Right, so final settlement value, this the technical way how they calculate the final settlement price. So I won't delve too long at that. You can always log on to Bursa website to have a look at the full specifications. Okay, so remember, one single point of mid-70 multiplied by 4 ringgit is 4 ringgit worth, and then every single movement is 20 ringgit. Okay, so let's look at the FM70 price and volatility. This is very important. Okay, what is the pricing and what is the volatility? Now, this chart is a chart from 9 December when I was preparing these slides. So some things may have changed, but not drastically. Of course, we made some new highs on the FBM mid-70 already. From in 9th December, we had a low of 8,952. And we have a high of 15,474. You can see from the low over here, it's almost doubled up to the high, right? It's of course in the new high, it's almost have doubled already. Now this is very interesting in terms of the volatility of the ability of the index to make and the profit potentials of this particular contract. Okay. The other thing I want you to look at is what we call the average true range. Average true range is an indicator of the volatility of the particular contract. Right. So currently on 9th of December, what the average true range is 163 points. What does this mean? This means that on a daily basis, the range between the high and low, the range that it moves is about 163 points. So what this translates to in terms of in ringgit is 163 points in the FM70 will be 163 points times 4, right? So this is roughly will be equivalent to almost like 700 over ringgit in terms of the movement in a single day between the range, right? So this is very, very interesting. So there's a lot of profit opportunities there as well, right? So for the low for this year is about 80 points, and the high you can see at the peak of it, right? This particular chart right over here, when the markets were, of course, down drastically, the high of the average true range was 400 over points. That's huge, right? 400 over points, let's say, for example, even say 450 points, you multiply by 4, that's easily 1,800 ringgit worth in terms of daily movement, right? So in terms of opportunity and movement, this FM70 is very, very interesting contract. Right? So we move on and give you an example of how if you're trading the what do you call that, FM70. Now I'm basing a lot of this on the FM70, what we call the cash index, which is the actual index, because the futures what do you call that contract has just been relaunched, so it takes a bit of time for the volume to build up. So I'll reference the prices and movements from the index, because when you trade the FM mid-70 index, it will be correlated to the cash index as well, right? So here we look at the bullish scenario, right? The example, if you're trading the FM70 and you are bullish on the market, suppose December FM70 is trading at 14,900. Of course, now it's above that. A futures trader buys one contract, one December contract. Okay, remember that there is this thing called monthly contracts on the FM70, right? And if I may just quickly go back to the contract months. For the FM70, you have what we call the spot month, the next month, right over here. You can see, you can follow my cursor. There's spot month, next month, and a next 2 calendar quarterly months. So at any one moment, there are 4 contracts in the market. So spot month basically refers to the month that we are currently in, which is December month. So currently December FM70 futures is the spot month. The next month is of course January, and the next 2 calendar months will be March and June. So at this current moment, there are 4 contracts traded on the FM70, which is the spot month, the January, March, and also June. Okay. Now these are available. Doesn't mean that it's active all the months. Normally for index futures, it's active on the current or the spot month. Okay. Just to give you a look at it. That's why we're referring to December month over here. Okay, so if we buy, say, for example, 1 contract of December FM70 futures at 14,900. Okay, suppose we do that. Now, there are 2 scenarios. Okay, you bought it at 14,900. So if the FM70 were to go up to 1,500, okay, that means there are 200 points. You gain 200 points. Okay, and remember, each point is how much? Each point is worth 4 ringgit. So if that is the situation, you bought at 14,900 and now it is at 15,100, you have a 200 point gain, and that is equivalent to 800 ringgit in value gain. Right, so it's in trading a bullish market, futures traders they use this term called go long. Okay, so when you hear this long futures, that means they bought with the view that the market is going up. Okay, long futures contract. Now, December's FN70 can drop, right? Okay, not every time you buy something that it will go up. So if it drops to 14,700, okay, it drops 200 points instead of going up, then the same thing. Okay, you have a 200 point loss. Okay, the 200 point multiplied by 4, which is a 800 ringgit loss in value, right? So there are 2 scenarios every time you go to market. Okay, markets may go for you and markets may go against you, and that's how you calculate the P&Ls for FM70. Now, in a bearish market, this is what you do, right? So, for example, in the middle of the first quarter of this year, if FM70 were available for trade, that would have been something that you could have done. Okay, you could have shorted the market, but in this situation, we are looking at December FM70 as an example at 1400. Okay, say for example, if you shorted 14,900 now. Okay, so this is a unique feature for those who are trading shares. Of course, this may not be a very familiar scenario, but in index futures, it's very, very common. People will sell an index higher with the hope that they can buy it back lower. Right. So in these terms, when they sell a December FM70 futures, they're selling at 1400, right? And hoping that later to be profitable, the prices will be lower than 1400. And in this sense, if we look at scenario 1, if December FM70 futures drops to 14,700, there's a gain of 200 from 14,900 to 14,700. There's a 200 point drop. Okay, but you are trading a bearish market. You are short on the market. If prices come lower, you actually are in a profit. So that 200 point profit will translate, multiply by 4 again, will give you a 800 ringgit gain, right? Now, if you are shorting the market and if markets rise, then you are not making money, right? So if you look at scenario 2, the December FM70 rises to 1500. Now, this position is against you, right? And it's against you by 200 index points, and 200 index points multiplied by 4 ringgit. That means that you have a floating loss here of 800 ringgit in value loss, right? So this is how you calculate the P&Ls trading the bearish or the bullish positions in FM70. We move on to talk about FBM KLCI futures. Okay, the FKLI, for those who are familiar, this contract has been there since 1995. When I first started in the business of futures, I was in this market, the FKLI. So it's a very well established index futures contract. Again, this is the active contract in Malaysia for index futures. And this is, of course, based on the KLCI, okay, the top 30 stocks on KLCI. And both the institutional and the retail investors go into the futures on FKLI, basically because they have exposures in the top 30 stocks. So a lot of foreign funds have exposure in our top 30 companies. And so they use the FKLI to do hedging or to do asset allocation. So in terms of the participation in the FKLI contract in Malaysia, almost half of the participation is by the foreigners, right? This is very interesting. So contract size in FKLI is slightly bigger in terms of the multiplier. It's 50 ringgit times the KLCI. So, for example, if the KLCI is at 1,006 multiplied by 50, the contract size for the KLCI will be 80,000 ringgit, right? 1,006 times 50 ringgit. Now, the minimum tick on the FKLI is 0.5 points, okay, which is equivalent, of course, half a point is 25. Every single point is 50 ringgit. Okay, so let's get a bit familiar with FKLI for those who are have not traded the FKLI before. So let's have a look at it. This is the contract specs again. What's the contract code? It's FKLI. That's the futures contract code based on the KL Composite Index, 30 stocks. The contract size is every single point at the KLCL multiplied by 50 ringgit. Okay. Now the contract months are similar to the same, in fact, to the FM70. Spot month, next month, and the next 2 calendar quarterly months. So there's 4 available and currently trading the same number of the same months as the FM70. Trading hours are the same as the FM70 as well, 8:45 to 12:45 on the first session. And the second session is 2:30 to 5:15. So it ends later than the stock market as well. So minimum price fluctuation, we already said, is half a point, which is 25 ringgit. Right. So similarly, daily price limits, final trading day, last business day of the contract month. And this is also a cash settlement contract. So there's no physical delivery for this contract. Okay, so let's look at some features of the FKLI, okay, in terms of price and volatility. So this is a very volatile year, as you can see here. We started the year, in fact, global market started the year very well. Okay, we were quite optimistic of 2020, and then the COVID-19 situation came about, and there was the market totally tumbled to a low of 1,000. What do you call that? Sorry, there's a typo over here. The low is 1171. The high is 1654. It's exceeded the high already. Right. Sorry about the typo over here. Right. Now let's look at the volatility of the FKLI. This year, the current volatility now is about 22.8 points. So it's about 23 points. So what does that mean? 23 points times 50, because each point is about, each point is 50 ringgit. So 23 points times 50 will give you the day's range in terms of the movement, right? So 23 times. So it basically about 1,000, almost 1,000, slightly over 1,000 ringgit movement per day currently, right? At the high, it was about 48 points, right? So 48 points, about 2,400 in terms of the movement in a day. Very big movement, okay? Yeah. And the low was about 14 points. So this was when it's before the COVID-19 situation. It was trading about averagely about 14 points range every day. Okay, so it is a very interesting contract as well. But you could contrast it to FM70. The FM70 tends to have a lot more movement in terms. The FKLI is a bit more steady in that sense, right? So we come to this very, very important subject called margins. Okay, futures contracts are all traded on margins, right? So whether it's a palm oil contract, a commodity contract, or a stock index, what does traded on margin means? That means you don't pay the full sum of the value of the contract. Okay, and all these margin requirements are set by Bursa Malaysia Derivatives Clearing. Now, I'd like to draw your attention to the table on the right. Okay, so let's take this futures contract, the KLCI, the FM70, and the CPO, and look at their notional value. Notional value is actually the contract value. Of course, this depends on the market prices, and we are taking the market prices at the close of 30th November 2020. So in terms of the FBM KLCI futures, the FKLI, the value at that end of 30th of November was 73,375. Now, how much do you need to trade one contract of FKLI? Now, the clearinghouse only requires you to put 4,002, right? You're trading 73,000, but your margin is only 4,002. The exchange clearinghouse actually asks only for 4,002. For the FM mid 70 futures, equivalent amount on 30th November will be about 60,000 ringgit. But now the margins to trade one FM70 is only 2,005. So you can see there's a big difference. And this is what we call margin, okay? Margins. The margins are the minimum deposits required to hold a futures position. And as you can see, it's a relatively small percentage of the actual notional value of the underlying instrument, right? Take a look at palm oil over here. Palm oil at the end of 30th of November, one contract of the crude palm oil was worth 82,000 ringgit. And you were only required to put 4,500 ringgit to trade one contract of crude palm oil. So this is very interesting because margins enable the most important feature in futures, which is called leverage. Okay, this is very powerful, right? This is where people say that it greatly enhances your returns. Okay, so if you look at, say, the FM70, 2005 against 60,000. Okay, even if we take 50,000 for a quick, easy reference, if it's 50,000, 2005, 50,000 divided by 2005 is about 20 times, right? So in terms of the FM70 over here, it's already more than 20 times. So if we take a 20 times leverage, it means that you have this very powerful multiplier effect, which we will see in the next few slides. Okay, but before we do that, let's talk a bit of margin calculations since we are in margins, because this is very important when it comes to things like margin calls and all that. Okay, now you assume, say, we assume a client has a balance of 42,000 in his account. Okay, and now holds 10 contracts of the FKLI December contract. Now, the maintenance margin of FKLI is currently 4,002. So the client, to hold 10 contracts, would have to have at least 42,000 in his account, right? So at this current moment, he has 42,000, which is just exactly what is required to hold that position. Now, if that particular day, the FKLI prices were to drop, and at the end of the day, say, for example, there was a loss of 2,000 ringgit, right? His account balance would have been reduced from 42,000 to 40,000. Right now, this 2,000 shortfall, because the exchange says that you need to have minimum of 42,000 ringgit in your account to hold these 10 positions. Okay, so this 2,000 shortfall is what we call a margin call. So the client would need to top up. Yeah, you have to top up this minimum 2,000 to make it up to at least the 42,000. Okay, so the broker will request for additional deposits called the margin call to be made until that minimum of 42,000 is achieved. Okay, if you want to continue holding that 10. We were talking about the power of leverage. Okay, in the previous few slides, we were talking about margins and why Bursa Malaysia only charge you a small percentage of the actual value that you are trading. Okay, and that's the power of leverage, right? So if I could quickly just go back to the previous slide there, so that you can have a look at what we were talking about. Okay. Here, right? So you needed only 2,005 to trade one contract of FM70, which was worth 59,000 at the end of 30th November, right? So this is that small little stone, that 2,005, which is carrying this 59,000 worth of stones over here. And this is a very powerful feature, right? And normally in futures trading, it typically gives you 4 to 10 times in leverage. Right? So this is the effect of leverage. Let's see how that works. Okay, we will compare it to someone who is what they call that, trading the Malaysian shares. If you are a share trader and you buy 80,000 worth of Malaysian equities, you would have to pay 80,000 for that purchase. So this is a cash purchase without leverage. Now, you could do the other thing. If you're a savvy trader, you could buy one FKLI futures contract, say at 1,600, say the FKLI at 1,600, which is actually equivalent to 80,000 in notional value, right? 1,600 times 50 ringgit. We said every single point was on FKLI was 50 ringgit. So it's the same 80,000 exposure in the Malaysian equities, right? Now, the thing is this, in the KLCI, when you're trading the FKLI, you only pay 4,002 for the purchase. That is the margin deposit that is required by the exchange, right? Now, what if the market moves up by 10%, right? So if stock prices were to go up by 10%, both of you would have made, those savvy trader would have made 8,000, the cash trader would have made 8,000 as well. But look at this, the FKLI contract has given the savvy trader, the futures trader, 19 times leverage. Where do I get the 19 times? It's basically the 80,000 notional value divided by the margin requirements, which is 4,002, which is 19. That's where you get the 19 times, right? So because you only use 4,002, the futures trader used 4,002 for his trade and made 8,000 ringgit. His returns was 190%. This is how you greatly enhance your returns, right? Through leverage. So basically, the market moved up by 10%. You had a leverage of 19 times, so you get 190% return compared to the cash trader who earned 10%. So this is how leverage works. But something to note, okay, now what if the market moved down by 10%? Okay, so that could happen, right? Not every time you buy into the market will actually go up. It could go down. So if you are a cash trader and markets went down by 10%, you would have lost 8,000, right? Similarly, the futures trader who bought the FKLI would have lost 8,000 as well. So in terms of 8,000 for the cash trader, you only lost 10%. But for the futures trader, you must remember, okay, you lost, you only put in 4,002, now you have lost 8,000. So this is a feature of leverage that you need to note, okay? Leverage works both ways. It can work for you, it can work against you. So the key to trading futures is the ability and the knowledge of how to control the downside of leverage, okay? Which is what we will talk about in modules 2 and modules 3 in January and February, okay? In detail when we're talking about that. So we move on. Okay, to give you an example of trading the index futures, this is a real example for the FKLI. Okay, this is the FKLI in November. So let's look at the FKL November contract in a bullish scenario. And this is a chart. You can see over here, this is a chart. Okay, on 4th of November, if you bought the November contract at 1473, and then on 11th November, you sold it at 1556. Okay, this is the selling point. And these are real market movements. Okay, you have a gain of 83 index points per contract. Right now, this is only 7 calendar days, 4th of November to 11th of November. Okay, there's a gain of 83 index points. How much is 83 index points? You have to multiply it for 50 for FKLI. This is 4,150 ringgit gain. Okay, and the margin required for the FKLI is 4,002. So you can see from here, in terms of 7 calendar days, you made 4,150. Your trade return over your margin, okay, is 98.8% in 7 days, right? And the index only gained 5.63%. So this is an example of the workings of leverage, right? The index moved 5.6% up. Your trade return compared to your margin that you paid was up 98.8%. Okay, so this is a very powerful, what we call an example of trading futures in terms of the leverage returns. Okay, we will look at a bearish scenario when you're trading the FKLI as well, and we'll take an October markets will come down. So we take an October, what do you call that, example. So we shorted October, okay, on the 28th of October. Okay, we took example from 28th of October. We sold over here. Okay, right here in the chart at 1490. And on 30th of October, okay, now 30th October is the final trading day for the October contract. So on October 30th, it expires. So there's a final settlement, right? You cannot trade it after 30th of October because that's the last day for the October contract. So we are taking a cash settlement in this example compared to the previous example. So you sold at 1490 because you were you were basically bearish on the market, and there was a final settlement of 1467.5. So that was the last settlement, the final settlement value, and there was a gain of 22.5 points. Multiply by 50, you get a gain of 1125 per lot. Right. So in terms of this 3-day trading, you have a trade return over margins of 26%, and the index only moved by 1.5%. Okay, in this case downwards because you're shorting, right? So again, you can see the effect of leverage over here. Okay, so this is a very, very powerful concept, right? So leverage, okay, is it a good thing or a bad thing, right? So we spoke a lot about the returns and the multiplied returns. You need to also note that, the downside is it can greatly multiply losses. So if you don't know how to use it, those who are amateur or newbies coming to market without trading knowledge, you can actually easily overtrade because you say, hey, I have so much capital, I can trade lots and lots of contracts, right? You may take risks more risk than you could afford. Okay, so that's the downside of leverage. The good thing, of course, it enables you to control a larger size exposure with a relatively small capital, right? Enhances returns. We knew about that. Of course, it multiplies losses if you're on the wrong side. And losses, as you said, as we've seen just now in the example, losses could go beyond initial capital. So this is something that you need to consider when trading futures, especially if you don't know how to manage the downside. So the key to trading futures is managing the downside, right? Because if you are right, the leverage will work for you when you're right in terms of the direction of the market. Okay, so professionals, when they trade, they know how to take advantage of leverage, right? So amateur investors or newbies who are ignorant on how to use leverage may make serious losses. So this slide is a very important slide that you need to take into consideration when you are trading futures, right? So I want to go into, let's see whether I can share with you a chart of the live chart. So we go to live charts. Okay, I want to show you the FBM 70, this updated charts. Just now we were looking at the 9th November chart. Okay, so this is so this is chart of the FM70. So you can see the movement a bit more clearer over here. We made, of course, the high. This is FM70 index. And this is not the futures because the futures still number of contracts doesn't show so well in the charts. So you can see here, for those traders who have been familiar with FKLI, you can see, of course, the FM70 has a similar correlated direction. But you can see the chart formations are very, very nice. Those of you who are familiar with charts, you can see very, very nice chart formations and very tradable. Okay, so we hope that when traders continue to participate in the FM70, you will be able to trade all these prices, which are fantastic, nice, very, very nice. If you are a chartist, you can see it's very nice chart movements. Okay, this is one thing that I want to show you. Okay, even on an intraday basis, if I show you, say, a 15 minutes charts of the mid 70, okay, of course, these are some gaps on the opening because the opening was very bullish, and you can see the chart formations are actually very orderly. So it's when you trade the FM70 or if you trade it on charts, it will display very nicely. So this is one thing I like about the FM70 as well in terms of the charts. Let's move on to also have a quick look at the FKLI. Or FKLI, you can see, of course, there are lots of volume on FKLI. This is the 15 minutes chart, very volatile as well this year. This is the hourly chart. You can see very oddly as well. So the FKLI, of course, is still extremely interesting to trade. Okay, so the only difference just now when we saw the FM70 is relatively a cheaper contract to trade. You only need 2,500 ringgit per contract to trade, whereas for the FKLI, this contract, you need 4,002. So that's one of the difference, of course, in terms of the affordability of trading the index futures in the Malaysian market. The FM70 is a cheaper contract to trade, but with similar volatility as well. Right. So this is just a quick look at the two contracts. I'll move back to the slides. Okay, let's move back to the slides. Okay, so let's talk about the pitfalls and risks of trading index futures, right? So we spoke about the risks coming, number one, mainly from the impact of leverage. Okay, so we need to use leverage wisely, right, in order to avoid over trading. All right, so this is very important. It's the key point in trading any futures contract, not only the index futures, because of the impact of leverage on your account. Right. The other thing is also emotions, because the movement is, of course, a lot more volatile. Then you are multiplied by the impact of leverage. Your account is moving very, very fast. So your emotions can run very high. Okay. There's, of course, fear if the market's going against you. There's the emotion of greed, of course, when the market's going for you. And there's ego as well. You know, all these three, which we will talk in the next few segments, are very interesting emotions that will come out when you trade. So one of the pitfalls of trading futures is your emotions can run high, and it's amplified like leverage as well. Right. So in terms of risk management, it is the critical component in trading the index futures well. Right. So you need to have what we call an airbag strategy. That means what if your trade goes wrong? What you need to do. So your strategy for that, okay, is you need to put into place. Right. It's just like driving a fast car, or you're driving a sports car. You need to have those safety features already enabled before you drive that car. Okay. Of course, number one is skill and knowledge, which Bursa Academy is an excellent resource for learning how to trade and about the products as well. So you need to be able to have the risk management strategies in place when you start trading index futures. Okay. Proper resizing is basically, we say just now, you cannot overtrade or should not advise not to overtrade. Proper resizing will have the recommended what they call that size for a certain type of capital, which we will cover in modules 2 and 3 as well. And then the last one is recognizing the difference between trading and investing. Investing in shares is a bit different, because investing is for the long term. Okay, you're holding for the long term, and expectations of returns are very different compared to trading. Trading is fast, especially in futures. A lot of traders even day trade. That means they go in today and come out by the end of the day. Right. And because you saw the movement, we spoke about the ATR, the average true range, the ability to take profits within the day is there. Right. So in terms of trading in index futures, the trading time, the period is much shorter than investments. Right? Investment, you're talking about a year, 2 years, or even 5-10 years down the road. Right. So this needs to be a distinction, and recognizing the difference between trading and investing. Important. So the roadmap to start trading index futures, these are the steps you need to take. Of course, to trade futures, you need to have a futures broker account, futures account. So you open it with a reputable and licensed broker, very important. Okay, do not open an account with an unlicensed broker. All the lists of the licensed brokers are listed on Bursa Malaysia website. So you can see who are these, what do you call that, licensed brokers in Malaysia, and trade with one of those licensed what do you call that, brokers. Okay, now you need to research, do a bit of research, and learn about the various type of strategies and trading methods. Okay, log on to Bursa Academy. There are a lot of webinars and seminars there talking about how to trade and different strategies that are available for you to trade. Research and find out what is your favorite strategy. Some of you may prefer a shorter intraday kind of strategy. Some of you may prefer maybe holding it for 1-2 days. Some maybe even for position trade. So it depends on your style. Pick a strategy that you are comfortable with. Okay, and determine what risk capital, and this is very important. What risk capital that you are willing to invest, and risk capital has to be got risk capital. You cannot be trading your what do you call that, your education fund of your children and all that. Right, this has to be real risk capital. That means money you can afford to lose. Right, it's very important. Okay, after you determine what risk capital to invest or trade, then deposit those margins with your broker to start. And my advice is, when you first start, if you're unfamiliar with the contract, start smaller. Okay, once you get better at it, then you grow your size. You can always grow your size and the number of contracts you trade according to the skill and the familiarity with the futures contract. As your what do you call that, as your knowledge grows, then increase your positions as you get better. Okay, so that is the roadmap to start trading index futures. right? So we've come to the Q&A session, okay? And I think some of you may have put in some questions into the trading panel. Ryan, do we have questions? Do we have already questions from the attendees?
Hi, David. Firstly,
Hi.
thank you for the wonderful insights. I am most certainly more interested in FM70. Yes, and we will definitely open up the Q&A session. There is a few questions from the audience, most notably from Sri, who is from Penang. She has two questions for you. One is, what is the code for FM70 in online trading? I think if you could answer that one, then I will ask you the following question after the answer.
Okay, now in online trading, if you're trading the futures, of course, you'll be trading through your brokers, okay? And those brokers, depending on the system, okay? Depending on the system you use, because different brokers may have a different system, okay? Of course, the contract code for this FPM70 is still FM70, okay, but these different systems may use a different notation in their system, right? So depending on the system that you use, I don't have a full definitive answer to that, but look for FM70 futures. There definitely will be FM70 index futures in that particular code, but each trading system may have a different notation for that contract code. Right, so you first will have that index code, the FM70, plus the month that you're trading. Okay, very important. You need to note the month that you're trading. Okay, so no definitive answer to that. Depends on the system that is provided by your broker and what system that you'll be using. Of course, you can trade online, right? But go back and consult with your broker and ask them what particular code for the FM70. I hope that answers your question, Sri. The second question, please.
Great stuff. And the second question from Sri is, can FM70 be traded online?
Most definitely, yes. Right. So depending on the system that you're using, all brokers currently will have facilities for you to trade online. So definitely a yes.
Great stuff. David, also we have a couple of minutes to spare, which I have one or two questions for you. The first question being is, how much capital is recommended to start trading FM70 or FKLI?
Okay, that's a very, very good question. How much capital to start? Now, as you've seen from the slides, to trade a FM70 contract, it only requires, or rather the exchange only requires to put 2,500 ringgit. Okay, of course, that is the absolute minimum, right? To hold one contract on FM70. FKLI will be 4,002. Now, the best recommended strategy, okay, is when you trade a certain contract, you need to have enough capital because markets move up and down, and sometimes you make good trades, and some trades don't work out, right? So you need to have a buffer. So if there is any minimum account size, I would recommend for trading Malaysian products to have to start with 10,000 ringgit. That would be a good start. So it gives you enough buffer for the movements in the position that you have. So I would recommend a minimum of 10,000 to start. If you have more, it could be better because it gives you a bit more flexibility to vary the number of trade positions. It's called position sizing. But minimum, I would recommend 10,000 ringgit. I hope that answers the question.
Brilliant, brilliant. And then if I am in a position with a margin call and I do not pay up, what will happen?
If you don't pay. Okay, good. Margin calls, if you don't pay, there are a few situations, okay? Now, if you hold a position, just now we saw the 10 contracts, 42,000 for the FKLI. Now, of course, there was a loss of 2,000 and you were supposed to top up at 2,000. Now, what if you don't, okay? Or not able to? Somehow you maxed out your risk capital. You said, okay, that's the maximum I want to put in the account. Now, there are a few things that can happen. The broker will advise you to reduce your position. Okay, so in that case of the trader with the 10 contract position, the broker will say, okay, perhaps you could reduce it to 9 contracts, of which that you will have enough margins to hold 9 contracts. Okay, so one, reduce position so that the margins that you have commensurate with the position size that you have. Number 2 is Normally, the broker will give you some time to regularize the account. If not, then they will first do the reduction of the number of contracts. If they can't reduce your contract, now let's say, for example, you're down to one contract and there's no way to reduce it. There is a certain threshold where the broker, in the terms and conditions that you sign with them when you open the account, would say that they have the right to take you out the market, right? So normally that threshold would be like 20 to 30%. If the market goes against you and it's down to only 20 to 30% of the balance required to hold that contract, they would have the right to take you out, right? So they will liquidate your positions. Okay, so that's something that we don't like, but that's part of the risk management as well. So that's what will happen if you don't pay up your margins. Of course, if the markets go back to for you, that would be wonderful, right? But sometimes markets are persistently against you, and you should have taken a loss. Actually, in terms of strategy, you should have taken it a long time ago, but then it deteriorated to that situation. Then the broker has no choice but to liquidate your position. I hope that answers the question.
Most certainly answers the question. And then just one final question is that how do I view prices for BMD index futures?
Very good questions. Okay. And of course, on the Bursa website, you can see the prices for the FM70 and FKLI. Those are delayed prices, okay, delayed probably like 15 to 30 minutes. If you want to have live prices, if you open an account with your futures broker, on the platform itself will have the live prices. So that's one way to do it, okay, if you already have a futures account. Request for the online platform, and you'll be able to see the live tradable prices. Of course, once you have funded your account, you can trade it. That's one way to see real-time prices. On the side, there are a lot of other providers of live prices. You see, just now I showed you my charts. Those are third-party apps that you can use. I personally use TradingView.com, so you can use TradingView if you want to, right? TradingView is a good platform which I use for charting. If you like charting, and it's quite affordable to apply for the real-time prices. Something like, not mistaken, is $1 per month. So that's very affordable. Okay, and the platform is free. So that's one thing you can do. But a lot of the traders who have live prices basically get them from the futures broker. So if you open a futures broker account, they'll give you a live platform, and from that platform you can see the live prices. So I hope that answers the question.
Thank you for that. I think with that, David, thank you very much. We are going to go into closing, and we are at the end of tonight's webinar. We want to say thank you to the audience members once again for joining this webinar and for being patient. And thank you to you, David, for sharing the insights and thoughts on FM70. We will look forward to the next series, which is series 2. Until then, have a good evening. Thank you, everyone.
Thank you, and good night.
Good night.